Have you ever wondered why 95% of everyday traders lose money? It happens because they are taught to swim in highly predictable patterns. And in the ocean of the financial markets, predictable means you are easy to hunt. Institutional traders, the massive banks and funds, act as the whales of this ecosystem. Their immense trading volume dictates exactly where the current flows. But being a whale comes with a specific challenge. Because they are so large, they cannot maneuver through the water without a steady supply of smaller fish to feed their momentum. In trading, we call that food source liquidity. Instead of thinking of it as complex math, just picture liquidity as a pool of available orders from everyday traders. A whale has to consume these small orders to have enough room to place their own massive trades. That brings us to the follow the money strategy. Instead of fighting against the current or trying to outsmart the predators, you can learn to read the wakes these whales leave behind. Market success comes down to a simple choice. You don't need to outswim the whale. You just need to track its movements so you can swim safely in its slipstream. To see the whale's path, we have to strip away the noise. Instead of looking at a confusing jumble of individual price candles, try viewing the market as a series of simple lines. In an uptrend, the market builds a staircase of higher highs and higher lows. This upward momentum is safe until the staircase breaks. If price drops to form a new lower low, the structure breaks, revealing the whale has changed direction. Of course, the ocean looks very different depending on your vantage point. A view from a satellite shows you the massive tide, while a view from a surfboard just shows the local chop. This diagram shows exactly how timeframes work together. The red line represents a higher timeframe, dictating the massive overall tide. The blue line represents a lower time frame, like a 1-hour chart, showing the smaller waves that happen inside that larger current. When the whale surges forward in the direction of the main tide, it creates fast, violent splashes. We call these impulse moves. This chart shows the difference between strong moves and when the whale rests. Notice the strong momentum arrow pointing down. That's a fast impulse. Then look at the complex pullback arrow pointing up. That is a slow, weak ripple moving against the main tide. By measuring the time it takes for these moves to happen, you can read the whale's energy. If a pullback takes much longer to form than the impulse did, you know the market is just resting before it strikes again. By patiently aligning the massive tide of the high time frame with the small waves of the lower time frame, you ensure you never swim against true momentum. Whales are essentially market wholesalers, and they follow a strict rule. They refuse to buy at expensive prices. They only feed when offered a deep discount. This chart shows how we map that feeding ground. By placing a 50% equilibrium line across a market wave, we divide the area into a red premium zone at the top and a green discount zone at the bottom. This image explicitly shows the instructions you need to follow. You should only look to sell when prices are pushed high into the premium zone, and only look to buy when prices drop low into the discount zone. This chart shows a classic trap known as a stop hunt. Follow the red arrow pointing down past the pink line labeled equal lows. The whale intentionally pushes the price just below those old lows to trigger the stop losses of the retail minnows. When those everyday traders get stop zapped, their forced sell orders flood the water. That flood provides the exact volume the whale needs to secretly fill its massive buy order. Once the whale's belly is full, it launches upward. This rocket-like move leaves an imbalance, a literal vacuum in the price where only buyers existed. This chart highlights the very last footprint the whale left before that rocket move. That yellow box is called an order block. Notice the note pointing out that price is expected to eventually return to this exact decision point. Because the market hates an empty vacuum, that order block acts like a heavy magnet. Eventually, the price will drift back down to fill the empty space. Think of these order blocks as the bus stops of the financial ocean. Instead of chasing the market, you can simply sit at the stop and wait for the perfect moment to catch the next big move. To put this together, you can follow a simple 4-step daily routine. Step 1, check the tide. Look at a higher time frame chart to see if the whales are building a clean staircase of higher highs. Step 2, wait for the discount. Do not chase a surging price. Let it relax and pull back below the 50% line into the cheap zone. Step 3. Find the footprint. Look for that moment where the retail minnows were swept out, followed by a strong impulse that leaves a clear order block. Step 4. Set your entry precisely at that order block using a lower time frame. This keeps risk incredibly small, with potential for massive reward. This manual excerpt highlights the most critical warning of all. Before you ever risk real money, you must put in the time to backtest these patterns on historical data until you know them by heart. By tracking the money instead of guessing where the market will go, you stop acting as liquidity for the predators, and you start trading alongside the true